what are called rolling returns? What is more important, trailing returns or rolling returns? We have our investment expert Mr. Hariharan with us to help us overcome these investment challenges. Hariharan, over to you.
When we talk of investment and selecting funds, the most easily available information is performance. So if you go to Google today and type top 10 mutual fund schemes, within 0.2 seconds, Google will give me 10 responses or 10 funds. So whether I do it or you search on Google, the answer is going to be the same. Okay, so please understand this very carefully. Irrespective of who searches, Google is going to give me the same top 10 scheme today. So that information is very easily available. And basis that information, lot of investors invest. Assuming that today this is the top 3 scheme, I invest in the top 3 scheme. But there is no guarantee that after 6 months or 1 year or 2 years, these top 3 schemes will even figure in the top 50. There's no guarantee. In fact, give you some statistics. The fund which was number 1 3 years back is ranked 167 today. 167. And the scheme which was, I think, ranked 50 or 63 years back is currently the number 1 ranked scheme. So what I'm trying to tell you is that just like the question around Corona, information that is easily available, basis that easily available information, we make those decisions. And that easily available information is performance. And every time you look at any mutual fund advertisement, they say that mutual funds are subject to market risks. And they also put a disclaimer that past performance is no guarantee of future performance. Just to give you some perspective, if you were to compare the performance of equity markets, this is Sensex data, 2008, 6th of January, if you would have done a lump sum, okay, on 6th of January 2008, exactly after 7 years, you would have seen the value of that performance on 6th of Jan 2015. This investment would have delivered a 20% return per annum. Okay. Now, instead of 6th Jan, you would have put it on 26th October 2008, which is roughly about 8-9 months later. And you look at 7-year performance from 26th October 2008 to 26th October 2015, your lump sum investment would have fetched you only 5% per annum return, worse than a fixed deposit. So what I'm trying to tell you is that while performance of the past is just an indicator, it does not guarantee that this fund will perform in the immediate 2-3 years. And to a large extent, it is also dependent, therefore, on what time you are entering. If you have entered on 6th of Jan, that was the best time to enter, 20% CAGR. So perhaps you had the best of the dashas running in your horoscope. You're the best of the best planets that point in time. But if you were to delay it by another 6, 7, 8, 9 months and invest, perhaps Sade Sati would have come in. You got only 5% returns. Okay. So when you look at past performance, we are now discussing analysis and research. What we are supposed to do, the right way is not to just look at past performance. What you and I see, and what I've tried to explain through these couple of illustrations is these are actual data, is that my timing becomes crucial, and depending on the timing, the experience of the investor is very different, isn't it? 2006 Jan 2008, the investor who would have invested would be extremely happy, and he would say that equities are the best, wonderful. But the same investment done by another person on 26th of October, you would say that pathetic, my FD was better, which means the timing determines my experience. And this is what can go wrong with all of us. And therefore, to sort of negate this, there is another way to evaluate performance, which I'm going to share with all of you. And that's called as rolling return. But before that, what we have discussed is called trailing returns. And just to give you more perspective of what I showed as an illustration, again, if you look at These are 10-year data points. Huh? So the tenor is the same. Everybody is invested for 10 years, but their experience is extremely different. So somebody would have started their 10-year journey on 30th of March 2010. They would have again performed very poor compared to fixed deposit. And mind you, it is the same market, the same index. But somebody would have invested on 30th of October 2001 would be 19.5% CAGR. So again, I repeat, when we look at past performance, it depends on what is the base before that period. So if I were to look at a 1-year return today and I say that Sensex has delivered 24%, versus if the last year has been very good and this year we have been relatively poor, my 1-year performance would be poor. So irrespective of tenor, when you enter, when you exit, determines your experience. And this is the drawback with looking at just trailing performance, which is what you and I get to see in Google. The better way to look at returns is what we call as a rolling return. Now, unfortunately, this is not a publicly available data, but you can still get it. Okay. So what is this rolling return? So you should look at a rolling return before you select that scheme and not just look at trailing returns. So what happens in a rolling return? Let me try and explain this in a very simple example. Suppose you have planted a seed. Okay. And the seed slowly starts growing. It becomes into a sapling. It starts becoming longer and longer, right? And let's hypothetically assume that you planted the seed 1 year back and you check the height of the tree now or the plant now after 1 year. So you get a 1-year performance in terms of what has been the growth in terms of centimeter or meter. On the other hand, what a rolling return does is that I plant the seed 1 year back. Every week, I find out what has been the length, incremental. So week 1, 5 centimeters, 15 centimeters, so on and so forth. So I got 52 data points now. Okay. Versus if I were to just look at the day when I planted and today, it's only 2 data points. So instead of 2 data points, which is what trailing return does, I am now capturing the growth weekly. And therefore, I have more data points. And that is what we call as a rolling data. So what the rolling data does is it calculates the performance for a fixed frequency, right? So if I were to just sort of explain this, if I were to get the 5-year return of the fund, which I have also put in this slide, if I want to get the 5-year return of a fund over the 10-year period between 2010 to 2020, I will calculate 5-year return periods for each day. So 2001, 1st January 2010, 5 years will be completed on 1st January 2015, 2nd January 2010, 2nd January 2015, so on and so forth till 2020. So you now see the number of data that is available. Instead of just 2 data points, you have thousands of data points that is now available. And then I calculate the 5-year return for all those periods and then average it out. What it does, therefore, is it now takes into consideration all the market scenarios. So it is essentially saying I am calculating the 5-year return for every day. Every investor who is now getting on different days, those 5-year data is calculated. And then I say that the rolling data for this fund is so much. Now, this is a better representation because it now captures everybody's returns. It captures ups and downs, different market cycles are captured in this instead of just 2 data points. So net as an investor, rolling return is a better indicator of performance. All right. And therefore, when you look at rolling return, it also sort of helps us to roughly estimate. I'm using the word roughly estimate the potential returns from that investment. I repeat, rolling return therefore also helps us to roughly estimate the potential returns from that investment. So let's look at the table and try to explain this. So when I look at a particular fund and I see that on a 10-year basis, these are rolling data, rolling data, the rolling return performances of 10 years, what it tells me is that if I, as an investor, invest in this fund and I stay invested for 10 years, the probability of making a loss in that 10 years is 0%. Okay? And the probability that I will generate more than 12% returns per annum is about 66%. If you take it to 15 years, invest in this fund for 15 years, it again tells you that if I stay invested, probability of making loss is 0%. Probability of making a 12% return per annum, more than 12% return, is roughly 90%. So rolling returns are the better indicator of what you can expect. Again, these are not guaranteed, but typically these are a better estimate of what you can expect from a fund. And therefore, instead of just looking at the most easily available data, which is trailing return, but rolling return is a better representation of performance.
Thanks for your detailed answer. If you have any doubt regarding this or any other financial or investment decision, don't hesitate to book an appointment with our financial expert. The link to the appointment is given in the description below. And also, would you like to know more about finance and investment? Then we would recommend you to attend our live webinar. The link to the webinar is also given in the description below. The webinar is absolutely free. If you like this video, hit like, and if you are new to our channel, please do subscribe.